If you're new here, welcome, I'm Paula. On this channel, we don't really do hype, price predictions, or this coin is about to explode thumbnails. What we focus on is understanding why markets behave the way they do, what's happening under the surface, and how crypto fits into the bigger macro picture. Not just as a trade, but as part of a changing global system. And today I want to talk about something that almost nobody in crypto or markets is framing properly yet, even though it's already shaping price action, volatility, and liquidity in a very real way. Because beneath all the discussion around rates, regulation, EFTs, and floating narratives, markets are now being constrained by something much more basic: energy. Not metaphorical energy, not market momentum, actual electricity, grids, fuel, and physical infrastructure. And once you see the connection between energy, geopolitics, crypto mining, AI, and infrastructure, a lot of recent market behaviour suddenly starts to make sense. Here's the first mental shift that really matters. Money is abstract. Debt is abstract. Liquidity is abstract. Energy is not. We can create money digitally, expand balance sheets with policy decisions, and issue debt almost instantly. But energy doesn't work like that. Energy requires physical resources, long-term investment, labour, infrastructure, and political stability. You can't QE a power grid, you can't rate cut a transformer into existence, and you can't scale electricity supply on a quarterly earnings cycle. Every part of the modern economy, finance, manufacturing, AI, cloud computing, and crypto, that means energy isn't just another input into the system, it's the physical limit of the system. For decades, globalization hid this constraint from us. Energy was cheap, abundant, globally traded, and largely politically neutral. Because of that, finance became dominant, and capital allocation mattered far more than physical limits. That world has changed. Today we're dealing with energy security concerns, grid congestion, years of underinvestment in traditional supply, increasingly politicised energy policy, and a more fragmented global system. And this is where geopolitics quietly enters the picture, not through dramatic headlines, but through constraints. Energy is no longer just priced by markets, it's controlled by states. Governments now treat energy as a matter of national security, strategic leverage, and economic power. Electricity demand growth today isn't really being driven by households anymore. It's being driven by data centres, AI infrastructure, defence systems, industrial reshoring, and electrification mandates. That means energy allocation becomes political. Who gets power and at what price increasingly reflects strategic importance rather than free market efficiency. And this is where crypto and AI start colliding. At scale, crypto mining is actually very simple. It converts electricity into computation and network security. For Bitcoin, electricity is the cost base. That hasn't changed. But what has changed is the environment around it. Electricity is no longer cheap everywhere. It's no longer politically neutral. And it's no longer universally available. Governments now care who is consuming power. Crypto mining doesn't disappear in this environment. It moves. It clusters in regions where energy is abundant, where regulation is tolerant, and where excess or stranded power exists. Hash rate starts to reflect energy policy rather than ideology. That's why mining geography keeps shifting. Not because of crypto cycles, but because of geopolitics and infrastructure. AI is usually framed as a software revolution, but in reality, it's an energy story. AI training and inference run continuously. They create spiky and non-interruptible demand, and they require dense, reliable power. From a government's perspective, AI matters more than crypto mining because it directly impacts productivity, military capability, and economic competitiveness. So when the grids are constrained, and many of them are, power gets allocated accordingly. AI is prioritized, households are protected, and everything else gets squeezed. Crypto mining survives precisely because it's flexible. It can be throttled, relocated, or paired with excess generation. But the competition for electrons is now very real. Whenever demand outpaces supply, capital doesn't chase the end product, it chases the bottleneck. Right now, the bottleneck isn't software, it isn't tokens, and it isn't even data. It's power generation, grid updates, transmission capacity, cooling, and energy storage. That's why capital is flowing into energy infrastructure, data center real estate, grid resilience, and power optimization. Markets always fund what's scarce, and what's scarce right now isn't ideas, it's delivery capacity. But let's look at the connection that most people miss. As energy costs rise, mining cost floors rise with them. Marginal miners are pushed out, networks consolidate, and supply issuance becomes more expensive. At the same time, liquidity is tighter, leverage is lower, and speculation is less reflexive than it was in previous cycles. This doesn't kill crypto cycles, it reshapes them. They become slower to ignite, structurally tighter, and far more explosive when liquidity finally returns. And that's why price action feels different this time around. Not broken, just constrained. We've moved from a financially constrained system to a physically constrained system. Markets still talk about rates, CPI, and central banks, but they react to power availability, infrastructure strain, energy security, and the geopolitical routing of capital. That's why rate cut narratives keep disappointing. Good news often underdelivers, and volatility feels compressed for long periods before suddenly becoming violent. Energy doesn't shock markets, it caps them. So once you see this, once you really understand that markets are now constrained by physical reality rather than just financial conditions, the most important shift isn't what you buy, it's how you think. Because in a physically constrained system, markets behave very differently to what most people are used to. They don't trend smoothly. Instead, you get long periods where nothing seems to happen, followed by sudden, aggressive moves that feel almost disconnected from the headlines. That's not random, that's structure. What this environment rewards is not speed, hype, or constant action. It rewards positioning, patience, and understanding where the real bottlenecks are. It means asking different questions. Not what's the next narrative, but what is physically scarce. Not when do rate cuts come, but what is actually limiting growth right now? Not what should explode next, but where does capital have to flow when constraints tighten? This is why conviction looks different now. Conviction isn't about being aggressively bullish all the time. It's about being selective. It's about understanding why certain areas survive stress better than others. About knowing when not to overtrade boredom. And that's why so many people feel unsettled in markets today. Their old playbook doesn't match the new system. We're no longer in a world where liquidity solves everything. We're in a world where resources, infrastructure, and geopolitics quietly shape outcomes, and financial markets adapt after the fact. Once you accept that, markets start to feel less confusing. Not easier, but clearer. And this is exactly why on this channel, we spend so much time talking about structure rather than price. Because once you understand why markets behave the way they do, you stop chasing noise and start positioning with patience. If you're new here or you just want a proper foundation for how we approach the markets, both crypto and macro, we've made a completely free lift-off course for you. It walks through how we think about market structure, risk management, and navigating both bull and bear markets without reacting emotionally to every headline. There's no pressure or upsell, it's genuinely there to help you build a framework. The link is in the description below. Before you go, if this kind of deeper macro-led thinking around crypto and markets is useful for you, make sure you're subscribed. This channel is about understanding how the system actually works, not chasing hype, not reacting to every headline, and not pretending anyone knows exactly what price will do next. We look at structure, liquidity, geopolitics, and long-term shifts, so you can make calmer, more informed decisions in markets that are becoming increasingly noisy. New videos go out regularly, and if you want to stay grounded while everyone else is getting emotional, you're in the right place. Thank you so much for watching, and I'll see you in the next one.